Thanks so much. Check in with Kate in a short while. There are still 3 trading days left in 2011, but one thing's for sure, the Australian share market will record a second consecutive year of negative returns to the calendar year. That's happened just one other time in the past 30 years. So as we farewell the year to forget and move into 2012, where are the risks and the opportunities? Well, George Lucas is from Instreet and joins with his outlook for the local and global markets in 2012. Very good morning, George. Thank you.
Brooke, thanks.
I was reading some notes of yours earlier, and one thing stuck out to me. You talk in terms of your outlook for 2012 as featuring perhaps investor fatigue and this sense of apathy, which I think we've all experienced already towards the back half of this year.
Yeah, and I think that's going to continue into the second half of 2012, if not just the first quarter, but maybe all the way to June next year. And when that continues, it makes it very hard to pick direction on the market because investors just go, oh, what do I care? That number came out, what do I care? I'm still just going to leave my money in cash or in the current asset allocation. And so information's not really being combined into the market. So it makes it very hard to understand what the investors are going to focus on, what bits of news are going to move the market, and therefore get the direction for the market correct.
Our market's been stuck in a trading range, really like the US markets, for some time. Maybe you can take us through some figures and what you expect out of 2012.
Yeah, and you know, 2011 was that we would have expected the Australian market to rise at the back end, just because the two things which happened actually happened in the market, which was we started to see interest rates fall and we saw dividend yields rise. And we would have thought with the increasing dividend yields, falling interest rates, it should have put a lot of support on the Australian market, but it didn't, and we saw the market fall. And I think that's going to be a theme again into 2012, where we're going to see interest rates continue to fall, but dividend yields rise. And it'll be quite interesting to see whether that actually supports the market or not. And that kind of goes to that investor thing, because people will just go, I'll just keep my money in cash and rather than going to the yield. So for the Australian market, we've got this range of about 3,800 to 4,350, and we really have to see the market break outside this range. We actually don't believe it'll happen until after March this year, and we think that it'll start trading back, move to the top and start trading back to the bottom of that range as we go into March. But we still see the Australian market range trading for the next 6 months. So from an investor point of view, you know, they go, a lot of investors see the same thing and go, we'll just sit on the sideline.
Why March? What happens in March?
March tends to be one of the times, there are 2 times in the year where liquidity tends to dry up a little bit. One's September and one's March. They tend to be 6 months apart. And so we see liquidity come out of the market in March, and we think when this liquidity starts to come out of the market, we'll see the market start trading down to the bottom of its range again at 43.50. And we see the same thing for the US market, where it just continues to range trade in this 1,300, 1,100 range, and continuing this range until a clearer picture about what's happening in Europe and also what's happening in the US. The US recently has had some really good, shown some growth momentum, and everyone's just going to be sitting on the sideline waiting to see whether this growth momentum travels into the the first quarter of this year. Yeah. And if it does, then it could provide a positive boost for the market. But it's just to sit on the sidelines and wait and see for a lot of people.
So there are some potential supporting factors there.
There are potential supporting factors, yeah.
One risk I saw that you've written about is the reduction in the commodity trade, and this kind of goes back to even MF Global and what's happening with the European banks.
So what we've seen, the French banks dominate the commodity trade, and we're talking about the physical commodity trade of providing finance so commodities can be bought in Australia and sold in China, and it tends to be provided by the big French banks. They dominate the market, and recently we've seen BNP and Credit Agricole make announcements that they're pulling out of this market, and so this will start to take liquidity away, and it won't allow people. It will kind of reduce the demand for commodities, and we could see this affecting the next 6 months in the commodity prices, which is obviously going to be a negative for our market.
When you look at the European problems more broadly, what do you see as the impact of these problems in 2012? Because I guess there's a camp which says there'll be a quick and sudden impact, maybe that's a default or some kind of downgrade or some kind of political event, and then others say that it would be kind of more of a slow bleed, maybe that trade just really starts to dry up and you get the slow grind into recession. Do you fit into either camp?
Slow grind into recession camp. I mean, there are really 2 things that you have to focus on in Europe. The first is what's happening in the banks, and the second is what's happening in the sovereigns. In the banks, it's all about reduction of capital at the moment, meeting their capital requirements, and they've only got 3 ways to really do this. They can raise more capital in the market, which a lot of banks are having difficulty doing. They can cut down their loan books, and which the banks are doing, and that's why we've seen banks like BNP and Credit Agricole pull out of this commodity market, because it's a way of cutting down their loan books, and therefore they boost their capital because the amount of loans that they've got have reduced. Or they can ask for government help and get capital from government help, and I think we'll see more banks asking for government help in Europe during 2012 to boost up their capital requirements. They've got to June 2012 to meet their capital to loan ratios, and that's what they're trying to aim for. But the net result of all this is that they're going to reduce the amount of lending that they provide small businesses and medium-sized businesses, which is going to slow growth in Europe. And so we're going to, and that's what's going to cause this, slow grind recession, is the fact that the banks are just going to tighten up their lending policy.
Well, this is what the ECB's 3-year lending facility was supposed to help, wasn't it?
Kind of. This 3-year lending facility was to meet the bank's immediate liquidity problems and to give them some insurance.
To shore up the balance sheet, though.
Yeah, but also because they had a lot of funding where they had short-term loans rolling off and they needed to refinance those loans, and so they could refinance them through the ECB. So what they've done, they just borrowed money in advance, and as these loans roll off over the next 6 months, they'll just be replaced by the ECB financing.
Yeah, well, it seems in the latest figures that the overnight deposits with the ECB have just skyrocketed. They've gone to record highs. Some suggesting that they've taken this very cheap money from the ECB through that facility and then stashed it overnight with the ECB, which they actually lose money on, which is incredible. But I mean, this is the short-term read, I understand.
Yeah, and they're doing that because they know when the current financing situations they have roll off, they won't be able to refinance them unless they go to the ECB. So they've just done it in preparation. Okay. But in reality, it's the amount of capital a bank has that controls the amount of lending that they can do, not the amount of funding that the ECB will give them.
Yeah. It's getting increasingly complex for retail investors, though, isn't it? And that's where we started the conversation.
Yeah, it's extremely complex at the moment. And so it makes it very hard to pick markets, and even things where you think which should support the market, like falling interest rates in Australia and rising dividends, they didn't. And so it just shows the complexity in the market at the moment.
The Australian dollar trading at about 101.5 at the moment. What's the outlook for the Aussie?
Yeah, so we're in the middle of its range. It's been range trading as well. It's been range trading for over a year and trading mainly between 97 cents and $1.10. I mean, it's a big range, but it's just been inside this range. It did have a breakout in March where it did fall down to 94 cents, but it bounced very quickly, like in less than 2 days, back inside the range. And so we're expecting it to hold this range and continue range trading. We actually are probably more bullish on the Aussie dollar than a lot, just because of the capital inflows into Australia. And these capital inflows into Australia aren't really based on what the price of coal or iron ore is today. They're dependent on, they're coming in because people are building infrastructure in Australia for projects for the next 5 to 7 years. And so they don't look at the forecast for commodity prices in the next 2 to 6 months. They're looking at forecasts for commodities over the next 5 to 10 years. And so as these infrastructure and CapEx projects continue, they're going to demand capital be brought in from offshore, and this bolsters the Australian dollar. And we're also seeing the Australian dollar becoming a bit of a safe haven, and that a lot of central banks are now increasing their reserves in Australian dollars, where before maybe just Asian central banks looked at Australia as a way to hold Australian dollars. We're now seeing globally central banks looking at the Australian dollar. So we're seeing an increased demand for Australian dollars from central banks, because Australia is being viewed as a safe haven, as we see, Italy, Spain, and all these countries which were previously perceived as safe havens falling off the grid. Fewer and fewer countries are becoming safe havens, and Australia is one of them.
One final question: inflation versus deflation. Where do we look for 2012? I
think inflation is not really a problem globally, and I think we'll see at the end of 6 months that the conversation will change from an inflationary conversation to a deflationary conversation. 2011, the inflation was dominated by a commodity spike. That's pretty much worked its way out of the system, and we should start to see, especially in the US and Europe, that the CPIs and the PPIs, which are a reflection of the inflation prices, by about the middle of next year begin to show that deflation is becoming a bigger threat. It's always been there, this deflation threat, except it was just covered up by a commodity spike that happened in late 2010, 2011.
Yeah. George, thank you very much. We'll be chatting with you in 2012, of course. So we thank you for your time today. Thanks, George.
Thanks a lot.
George Lucas from Instreet with the outlook for the local and global markets for 2012.